Good morning and namaskar. Let me welcome you all to the first policy of this financial year. At a time when the global economy is facing unprecedented challenges, from heightened geopolitical tensions, the conflict in West Asia, for which a temporary ceasefire was announced today, and the disruption in global supply chains. Before the outbreak of the West Asia conflict, India's macroeconomic fundamentals exuded confidence, with buoyant growth and low inflation. Conditions, however, turned adverse in March with the widening of the conflict zone and its intensification. The fundamentals of the Indian economy are on a stronger footing at the current juncture than it was in previous crisis episodes, as well as relative to many other economies, providing it with greater resilience to withstand shocks. Global growth faces increasing downside risks as the sharp rise in energy prices and shortages, some of which we saw a correction today in the prices of energy, and shortages of inputs for various industries have stoked inflation fears and pushed up the geopolitical risk premium in the oil markets. Heightened uncertainty precipitated by the ongoing conflict is weighing on the outlook. Safe haven flows have exerted depreciation pressure on currencies of major economies as the US dollar strengthened, while commodity prices such as of metal and gold have moderated. Financial markets have become more volatile. Equities registered a broad-based correction. Sovereign bond yields, already elevated due to long-run fiscal sustainability concerns, driven by inflation fears, have hardened across major economies. I now come to the decision of the Monetary Policy Committee. The Monetary Policy Committee met on 6th, 7th, and briefly today in the morning of April to deliberate and decide on the policy repo rate. After a detailed assessment of the evolving macroeconomic and financial developments and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged under the liquidity facility at 5.25%. Consequently, the STF rate remains at 5% and the MSF rate and the bank rate at 5.5%. The MPC also decided to continue with the neutral stance. I shall now briefly state the rationale for these decisions of the MPC. The MPC noted that since the last policy meeting, geopolitical uncertainties have heightened significantly. Headline inflation remains contained and below the target. However, upside risks to the inflation outlook, driven by increased energy prices, pressures, and probable weather disturbances affecting food prices, have increased. Core inflation pressures remain muted, although supply chain dislocations and the risk of second-round effects render the future inflation trajectory uncertain. The MPC further noted that high-frequency indicators till February of this year suggest the continuation of strong momentum in economic activity. Growth impulses continue to be supported by robust private consumption and investment demand. However, the West Asia conflict is likely to impede this growth. Higher input costs associated with increase in energy prices and international freight and insurance costs, along with supply chain disruptions that could constrain availability of key inputs for downstream sectors, would impair growth. The government has taken several measures targeted at supporting exports and protecting supply chains. This should mitigate the adverse impact of the conflict. The MPC opined that the intensity and the duration of the conflict, as well as the resultant damage to the energy and other infrastructure, add risk to the inflation and growth outlooks. However, the fundamentals of the Indian economy are on a stronger footing, providing it with greater resilience to withstand shocks now than in the past. It also noted that the economy is confronted with a supply shock. It felt, therefore, prudent to wait and watch the changing circumstances and the evolving growth inflation outlook. Accordingly, the MPC voted to keep the policy repo rate unchanged, even as it remains vigilant, closely monitoring incoming information and assessing the balance of risks. The MPC also decided to continue with a neutral stance, retaining the flexibility to respond judiciously to incoming information. Before I provide an assessment of growth and inflation now, let me briefly elucidate on the channels of transmission through which the Indian economy may get impacted by the ongoing conflict. First and foremost, elevated crude oil prices could increase imported inflation and widen the current account deficit. Second, disruptions in energy markets, fertilizers, and other commodities may adversely impact industry, agriculture, and services, reducing domestic output. Third, heightened uncertainty, increased risk aversion, and safe haven demand could impact domestic liquidity conditions, economic activity, consumption, and investment. Fourth, weaker global growth prospects may dampen external demand and reduce remittance flows. Finally, adverse spillovers from global financial markets could tighten domestic financial conditions and raise the cost of borrowing, some of which we have already witnessed. Overall, the initial supply shock can potentially transform into a demand shock over the medium term if the restoration of supply chains is delayed. I now come to the assessment of growth. As per the new GDP series, real GDP growth for last year is estimated at 7.6%. This corroborates the underlying strong momentum in economic activity supported by robust consumption and investment. Amidst supportive policy measures, ongoing structural reforms, and favorable financial conditions. Going forward, elevated energy and other commodity prices, as also shocks to availability of inputs due to disruptions in the Strait of Hormuz, are likely to impact growth this year. The government has, however, been proactive in ensuring supply of inputs across critical sectors to minimize the impact of supply chain disruptions. On the other hand, sustained momentum in services sector, persisting impact of GST rationalization, which was carried out last year, and the healthy balance sheets of financial institutions and corporates should continue to support economic activity. The agricultural sector's prospects are supported by healthy reservoir levels, business expectations remain optimistic, and leading indicators point towards continued resilience in manufacturing and services sectors. Moreover, the government's focus on scaling up domestic manufacturing in several strategic and frontier sectors augurs well for India's ensuing growth trajectory. On the demand side, private consumption this year is expected to be supported by discretionary spending. Rural demand remains robust. It should gain further traction on the back of favorable agricultural conditions and a healthy labor market. Urban consumption is likely to strengthen further, aided by the beneficial impact of GST rationalization and the buoyant services activity. While the government's thrust on infrastructure spending continues, the revival in private sector investment is expected to sustain on the back of high capacity utilization, strong credit growth, and benign financial conditions. On the external front, merchandise exports could be adversely impacted from disruptions to key shipping routes, the concomitant rise in freight and insurance costs, and lower global demand on account of the conflict. However, merchandise exports may benefit from the recent trade agreements, many of which were signed last year, and few of them are now in implementation, and others to become operational hopefully this year, while services exports are expected to remain resilient. Taking all these factors into consideration, real GDP growth for this year is projected at 6.9%, with Q1 at 6.8, Q2 at 6.7, Q3 at 7, and Q4 at 7.2%. Further escalation and wider spread of the conflict, as of now, of course, we have a ceasefire, heightened volatility in global financial markets and weather-related events, however, weigh on the domestic growth outlook. Risks to the baseline projections are tilted to the downside, with uncertainty remaining elevated due to the ongoing West Asia conflict. Coming to inflation, in January-February, headline inflation continued to remain below target. It was 2.7% and 3.2% respectively, with food group recording inflation. It was in deflation mode, as you are aware, in the previous 4 months up to December. Inflation in fuel terms was modest, core inflation at 3.7%, and the underlying price pressures benign, as evident from the much lower core inflation if you exclude precious metals. Turning to the inflation outlook, recent spikes in energy prices due to the conflict have emerged as a risk. Although retail prices of petrol and diesel have remained unchanged so far, the pass-through of higher global energy prices has resulted in some price increases in a few other fuel items. Food price outlook remains comfortable in the near term, with a robust Rabi production that we had, adequate reservoir levels which would help agricultural activity, and comfortable buffer stocks of food grains. The likely emergence of El Nino conditions could pose a risk. Considering all these factors, CPI inflation this year is projected at 4.6%, with Q1 at 4, Q2 at 4.4, Q3 at 5.2, and then going down in Q4 to 4.7%. Core projection is projected at 4.4%. We are doing this for the first time, as has been the demand from some quarters. And going forward, we shall continue giving our projections for core inflation too. Excluding precious metals, core inflation is even lower, indicating that underlying inflation pressures are expected to remain contained. The risks are on the upside. I shall now speak about the external sector. Global trade is expected to witness a slowdown in growth during 2026, as compared to 2025. This is due to the lingering tariff-related uncertainties, despite the Supreme Court judgment, ongoing West Asia conflict, and elevated energy prices. India's merchandise exports contracted by 0.2% during the first 2 months of this year on a year-on-year basis. This was a result of export contraction in key markets. Merchandise imports, on the other hand, recorded a double-digit growth of more than 22%. This is largely driven by higher gold imports. As a result, there was a widening of the trade deficit. Expected robustness in services exports and inward remittance receipts during Q4 last year, however, should keep India's current account deficit moderate and within the sustainable level last year. Rising global uncertainties and elevated prices of key energy commodities pose some upside risks to India's current account deficit this year. The recent bilateral and regional trade agreements with major trading partners are expected to boost India's trade and investment opportunities, while at the same time, they will also widen and diversify India's trading partners and integrate India into global value chains. On the external financing front, gross FDI witnessed a strong growth, almost about 20%. Net FDI also showed improvement on a small base of last year. India remains an attractive destination for greenfield FDI projects. FPI to India, driven by outflows, primarily in the equity segment, recorded net outflows of $16.5 billion last year. And even this year, till we have data till April 6, there were outflows of more than $5 billion. Flows under ECB and non-resident deposits too moderated as compared to last year. And as on April 3, for which we have data, latest data till April 3, India's foreign exchange reserves stood at a healthy $697.1 billion. These are adequate in terms of the standard metrics of reserve adequacy, whether one sees it from the perspective of import cover, we have about 11 months, as has been the case for some time, or whether one looks at it from the perspective of external debt. Overall, therefore, India's external sector indicators remain favorable. Nonetheless, elevated global geopolitical, trade, investment uncertainties require a continuous vigil of the evolving developments.